been a good year for gold bugs, with the metal up over 14%. As economists, though, have pulled back on recession forecasts, we have seen gold's climb stalling out below $1,500 an ounce. Joe Cavatoni is managing director at the World Gold Council. He's here with us now to look at what has happened this year and what might yet happen. So, indeed, we've seen a little bit more optimism in the global economy, or less pessimism, perhaps, and gold has been a little bit sideways.
Well, I think that that's an accurate short-term statement. Where our dialogue is with clients, where we are spending our time making sure people are educated on the market, is that there are tactical factors that'll drive gold. For example, opportunity cost over the last couple of weeks, risk on transactions, people looking at equities, trying to catch that upward trajectory, and also momentum that plays into the tactical side of things. But what we're really spending more time doing is talking about the strategic drivers of gold. Things along the lines of economic expansion and actual risk and market uncertainty. Those two factors are the ones that drive the long-term trend in the gold price.
So explain to those of us who are just kind of basic investors. Demand for jewelry is down. Demand for in India, in the United States. Central banks were adding gold, but not nearly at the levels they had in the year past. And yet the supply is also up 4%. What's driving the price higher? Is it fear?
So there is definitely, in the strategic category of what's driving gold right now, market risk and uncertainty, and you can go down the laundry list of items: China trade, tariffs, market uncertainty, and geopolitical risk in Europe. Just keep going down the line in terms of the different risk factors that are outstanding. So while we're looking at the GDT report that we have out for third quarter, our trend report on demand and also supply, what we're seeing are factors in India and China, where 50% of the demand is consumed worldwide for gold. The jewelry markets are showing signs of tapering off from where they were. They tend to do that when the price hits a toppy level. So we're hitting up to the 1,500 level, so they tend to pare back. But the dual nature of gold, where market risk, investments, central bank buying, policies around monetary controls, et cetera, take into effect, they start to balance it out. So you're seeing highs in terms of central bank consumption. I think we are at near 10-year highs in terms of the amount of gold and actually the consistency the central banks have been purchasing. So while we are off third quarter of 2019, we are against the world's record in terms of 2018 third quarter. So still a very high number.
Given the amount of money that central banks print, it's almost a rounding error what they're buying in gold at this point. What's it going to take to actually break out above those 2011 levels that so many gold bugs point to?
So there's a couple of factors that we're keeping an eye on. Market risk is definitely the number one item that we continue to keep in mind in terms of the breakout, because if people are going to be risk off, we know that gold will play a very important role as a safe haven in your asset portfolio. Secondly, we also want to see about what's going to be happening with monetary policy. Gold is a global asset. It's driven by many factors. It has a dual nature. It works well in good economic times, and it works well in market risk. So as emerging markets, which consume 70% of gold, continue to show trends and trajectory about what's going to develop there, we're going to keep an eye on that as well.
Now, when you say it works well, how do I move away from thinking that gold is just an asset protection mechanism versus something I can actually get yield from?
I'd encourage you to go to goldhub.org or .com and take a look at the return profiles that we can demonstrate to you. Gold is up 14%. So while it has no credit risk, therefore it shouldn't pay a dividend, or a coupon, I should say, because it's no one's credit risk. It does have a return profile that you can achieve over time. And if you look 1 year, 5 years, 10 years, you will see the return profile is comparable to that.
What about the threat of Bitcoin? I mean, I hear this so often. It's now becoming another alternative asset class. A lot of the people that like Bitcoin were former gold buyers.
Maybe, but I can't find that empirical evidence to demonstrate that. And the big number that we look at is performance, and actually we pay attention to correlation. When you look at what gold does and how it correlates to other assets, it does better than certain commodities, if not the broad category of commodities together, but it also correlates well when equities are off. Bitcoin tends to correlate with equities.
Well, Bitcoin's up more than 100% this year, but it was down a lot last year, to be fair. Joe Cavatoni, thanks for being here at the World Gold Council.
Thanks for having me.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.